Good morning, this is your Biznation Bulletin with me, Henry Winter. And to start with, markets went wild on Monday as pharmaceutical giant Pfizer announced that its COVID-19 vaccine, developed by German biotech company BioNTech, was over 90% effective in late-stage trials. 40,000 people were involved in the study over a 3-week period, with half of the participants using the vaccine and the others using a placebo. Although there's still many hurdles to overcome before the vaccine reaches the public, not least getting approval from regulators and the small matter of distribution, markets became very aroused. Long neglected stocks in the travel and hospitality sectors soared, with British Airways owner IAG and Gym Group up 25% and 38% respectively, whilst other stocks such as Zoom and Peloton fared less well after seeing an initial boost during the pandemic. This isn't the only vaccine in development at the moment, so here's hoping there's more good news to come. The UK has announced a record 15.5% growth in the third quarter of 2020, according to ONS figures. But as one-time presidential hopeful Andrew Yang reminded us last month, when GDP falls, it has to grow from a lower base. Gross domestic product, abbreviated as GDP, is the total value of goods and services produced in a country. Thus, a country's GDP is the total of consumer spending plus business investment and government spending plus net exports, which is total exports minus total imports. So even with this big growth headline, the UK's economy remains 8% smaller than it was before the pandemic. The UK did bounce back strongly from a poor first half of the year. This encouraging growth was helped in part by the Eat Out to Help Out scheme. However, it should be noted that growth is starting to show signs of slowing, and so a V-shaped recovery looks unlikely, although it's not expected that this decreased rate of growth will be as bad as the first half of the year, when Britain's economy shrank by 2.5% in the first quarter and a record 19.8% in the second quarter. But with the UK entering a second lockdown in November, it seems inevitable that the UK economy has a few more battles ahead. Fashion brand Supreme has been acquired by VF Corporation for $2.1 billion. The clothing company, which is known for its box logo and high-profile collabs, is not your typical fashion business. Supreme does 60% of its sales online and expertly hypes up its merch drops, mainly through its social media channels. So to celebrate this highly exclusive brand, let's take a look at what some of its most expensive items could have set you back at market value. As you can see, a Supreme drum set would cost $30,000. If you throw in an extra $5,000, then you could bag yourself the Supreme XLV backpack. And if skateboarding is more your line, then all you need is a mere $90,000. So who is selling Supreme and what's in it for them? Well, in 2017, private equity firm Carlyle Group bought 50% of Supreme for $500 million. The private equity firm has a history of flipping assets, buying 50% of Beats for $500 million in 2013, before selling to Apple for $3 billion less than a year later. Not a bad return. So with Supreme's $2.1 billion sale to VF Corp, Carlyle has continued that trend, doubling their initial investment. VF are confident their existing expertise in athletics and street clothing will keep the Supreme brand cool, but others in the retail industry aren't so sure. Although North Face, Vans and Timberland, all who were acquired over the last 2 decades, still sell, albeit through less than trendy retailers. So you may see a shift in their business model from highly anticipated exclusive drops to more widely available threads. Bro? On Wednesday, virtual event startup Hopin announced it's closed its third funding round of 2020, raising $125 million at a valuation of more than $2 billion. The amazing thing about this is Londoner Johnny Boofahat, great name, only launched the company in 2019 when he fell sick and was homebound for 2 years. Boofahat launched his brainchild Hopin as an alternative to attending events in person. The concept allows people to immerse themselves in live events as if they were really there. Like Zoom, COVID-19 has accelerated the growth of Hopin, boasting $20 million of annual recurring revenue and 3.5 million users already. They went from 4 employees at the beginning of 2020 to over 200 now, and is targeting 800 by 2021. Still not impressed? Well, put this in your pipe and smoke it. Hopin is already profitable, which is almost unheard of in any tech company's first few years. This makes it one of the fastest growing startups ever, and has already seen it crowned a unicorn. That's right, it's not just a pretty horse with a horn on its head. A unicorn can also be a private company, one that isn't publicly traded in the stock market, that has a valuation of $1 billion or more. Calculating a valuation can get complicated once you get into the details, but usually when someone says it, they mean the number of shares in the company multiplied by the price per share paid in the most recent funding round. And finally, McDonald's is getting involved in the plant-based food hype after announcing it'll introduce a line of meat alternatives called, wait for it, McPlant. Bet marketing spent millions on that one. The fast food giant says it'll begin offering plant-based burgers, chicken substitutes and breakfast sandwiches in 2021. McDonald's has already tested out a meatless burger in Canada in partnership with plant-based meat producer Beyond Meat. However, shares of Beyond Meat plummeted after McDonald's announcement, as it wasn't clear who would supply the fast food chain with the meat alternative. What a mug pickle. Well, that's all your Biznation news for this week. Thanks for tuning in, and we'll see you again next time. Bye-bye.